I can identify 3 principles that for me, in my opinion, options traders should really be aware about. And for me, if you really focus on applying those principles, everything will always be okay because you'll always be able to get back on your feet. Regardless if you have losses, regardless if you're wrong in your trades, you just need to follow those 3 principles. That's why in this video I wanted to share those principles that I've really tried to apply for myself for a number of years, and hopefully they will help you understand why it's so important to follow those principles and how they can help you. And if at any point you find this video interesting and you actually learn something, please consider subscribing to my channel and liking this video. That's really the best way to support me, and I'd really appreciate it. And when I was starting out in trading, and way before I started getting really into options, I genuinely believed that anyone who was actually good at this, it was because they had a great instinct. But then after learning from experienced people and understanding why they were taking the decisions they were taking, I understood more and more that they were not at all based on instinct. They were more based on a structured and strategic process that they were just following, and they were applying this over and over again. Which leads me to the first principle that I wanted to talk about in this video, which is strategy over assumption. And that's a very, very big one when you think about it. And I truly believe that knowing how to be strategic and how to strategize something is really one of the greatest underrated skills that you could actually learn in trading. And in the end, I truly believe that it's way better than following what we call instinct. And let me explain why. If making money in trading was only about instinct, how hard it could be to actually make that over and over again. Because think about it. If you have a bad day, for example, you have some emotional drawdowns or something happens in your life, if you're only trading based on instinct, your trading decisions will be 100% affected by your instinct. And as much as they can be affected even though you have a good strategy, if your trading is only based on instinct, it's going to be very hard for you to be consistent on the long term. Whereas if you follow a strategy, if you follow a structured process that you have backtested, for example, that you know is working, or at least that has worked in the past, it's way easier to trust that process and to really put your faith into that process and make those trading decisions based on a strategized process rather than following your instinct and potentially make emotional decisions that could cause you to lose money. And I truly believe that strategizing is something that is so important to do, at least in options trading. And to really become good at this, I really recommend you to watch the show from Tastytrade, Market Measures. This show is about what backtests they do, what are the results of the backtest using different strategies, and it's honestly a very good teacher because you can see based on what happened in the past, what has worked and what hasn't worked. So you can after that make better and informed decisions in the future. And to be fair, when I started trading, I was only making decisions based on instinct. I was buying here because I thought that the stock was going to go, and I was really trying to come up with my own decisions. And fundamentally, there is nothing wrong about trying to come up with your own decisions. But I truly think that it's way easier to follow a process that you know has worked in the past that you're trying to repeat for the future, rather than trying to follow your own instinct, which I know as humans we tend to be very biased in the decisions we tend to make. And I can assure you that on the long term, it's way more reassuring to follow a process where you know that this backtest has shown that, for example, this strategy has worked, rather than trying to follow your own instinct where you cannot really backtest your instinct. After that, as I said, it's only my opinion, but I've found that following a process that I know at least has worked in the past that I'm trying to repeat for the future is a much better way to trade rather than trying to follow my own decisions. And I definitely recommend you, especially if you're just starting options trading, not to try to come up with trades based on your instinct, but rather trying to come up with trades based on what has worked in the past. And you will see that with more time and experience in the market, you will come up with more instinct, but it will be because you will have assimilated a lot of strategies and you will know what has worked in the past and what hasn't. And in the end, you'll see that there is a lot of trials and errors, and it's completely normal. And talking about trials and errors, that leads me to talk about the second principle that I wanted to talk about. You see, you can have the best strategy in the world, you can know what has worked in the past or what hasn't worked in the past. In the end, if you cannot get in a trade and get out of a trade with your profits, no strategy will be able to help you. Hence why my second principle that I always try to follow myself is that liquidity is key. And if you've been watching some of my videos, you know how obsessive I am with liquidity, because I truly believe that regardless of what you try to do, you should at first make sure that the product that you're trying to trade, meaning the stock or the ETF that you're trying to trade, is liquid. Because think about it, if you cannot get in a trade or get out of a trade with your profits because the stock is illiquid, well, what's the point of trading it in the first place? And that's a problem that I've had myself very much when I was starting to trade because I was trying to take trades on very liquid options. And to be honest, that caused me to have a lot of troubles with a lot of trades, and I lost a lot of money like this. And I talked about it in my previous videos about why trading weekly options can be a terrible idea. And to help you understand if something is liquid, you need to check the open interest. And for those who don't know, the open interest refers to the number of outstanding contracts that are currently being held right now. In other words, it just tells you how liquid is the option that you want to trade. The bigger the number, the more liquid it is. The smaller the number, the less liquid the option. So ideally, you want to trade options that have a very high open interest because it will mean that there's a lot of participants for that particular option. And the more participants there are, the less trouble you will have to get in and get out of a trade. And that's something that is so important, because what's the point of making all of this work of trying to find the best strategy if you cannot get out of a trade with your profits? After that, if you're only trading very famous products or ETFs such as the SPY or stocks like Tesla, Apple, you will very often have liquidity and you won't really have a lot of troubles. But if you're trying to diversify your portfolio and you're trying to trade different stocks or ETFs, you really need to check the open interest so as to make sure beforehand that you have liquidity to get in and get out of the trade easily. But you can try to respect as much as possible the first two principles that we just talked about, but they won't work if you don't try to respect the third one. And the third principle is the most important thing that I have learned in trading. And it's a very, very simple rule, and you probably have heard about it a million times, but I can tell you for a fact and from experience that if you don't respect it, you will get burned so much and you will lose all your money. And that is to trade small. And I know it's something that you probably have heard a million times already. And maybe right now you're thinking, well, you know, I know this, I've already seen it and learned about it a million times. But you only know this principle and you fully understand it only when you experience the opposite. Meaning you only understand how important it is to trade small only when you've been trading too big at some point. And I know that if you watch this and you understand this principle, it's probably because you've been trading too big in the past and now you understand the importance of trading small. And you know, I don't necessarily have dozens of years of experience in the markets, but if I have learned something during the years that I've been trading, is that I really, really need to trade small. And you know, you can make a lot of mistakes in trading and you probably will do a lot of mistakes and you can actually come back from all of those mistakes. There is no problem. But the only mistake you cannot come back from is if you trade too big. And I think it's something that is due to the Kroger effect, meaning that when you start understanding more about a subject, it's very easy to become overconfident. And that's something that we call the Kroger effect, meaning at first you think you know a lot, but the more you get into the subject, the more you realize that you actually don't know much. And that's something that happened to me, and I had a very, very costly lesson because of this. And that's why I'm telling you that trading small is the most important thing. You can do as many mistakes as you want. Please don't trade too big. Because think about it, in trading, the capital that you have in your trading account is the most important thing. It's the engine of your business. It's the lifeblood of your business. If you don't have money in trading, you cannot trade at all. So you really need to make sure that you preserve this capital and you try to make the best and informed decisions that you can. And especially if you're just starting and you've gained a bit of money, becoming overconfident is very easy in trading because it makes you feel like you know something. You feel like a genius, you feel like you know something that other people don't, you feel like you've learned a strategy that no one has, and you start trading bigger and bigger, and one day the trade goes against you and you lose a lot of money at once. And that's something that happened to me. That's something that happens every day to a lot of people. And if I had to say the most important principle between the three principles that we just talked about, trading small is probably the most important thing. And I know it sounds cheesy and I know you probably have heard about it, but to be honest, it's probably the most important thing that you could do in your trading. And to make a summary of the three principles that we just talked about, strategy over assumption, liquidity is key, and trade small. For me, those three principles are very, very fundamental to any success. And even if you follow those three principles, it doesn't mean that you'll be automatically successful. But I truly believe that without them, there is absolutely no way that you can make positive returns in the markets. I hope you enjoyed this video where I share my top 3 principles, and I hope that it will help you make better and informed decisions. If you've been watching until the end, I really thank you very much. I really appreciate it. And don't hesitate to subscribe and like this video if you've been liking it. I'll see you in the next video, and in the meantime, I wish you all the best.